Hello, I'm Michael Hainsworth. Retirement income isn't just about how much you spend, it's about how much you save in retirement. Inflation may be cooling towards the Bank of Canada's 2% target, but a retiree's basket of goods rarely behaves like the national average. This is Daryl Diamond.
Plan to have some capital or some income dedicated for mailing down the road in whatever way you choose to do that. Growth investments, reinvestment of distributions. That to me is not only an effective way to deal with inflation in the future, but it also helps you as a retiree be more comfortable with what you're spending now.
You're not just spending in retirement, you're saving in retirement too.
Correct.
On this episode of On the Money, we'll explore the reality of today's inflation and build a retirement income blueprint that stands up to rising prices and uncertain markets. Because in retirement, stability isn't a luxury, it's the plan. Inflation may be easing, but retirees aren't breathing a sigh of relief. How do we build a portfolio that prepares us for retirement, and how should an existing retiree view their monthly income? I wanted to start by getting Daryl's take on the current state of inflation. Daryl, help us understand where Canadian inflation is right now, and I suppose most importantly, what this means for retirees who rely on regular income.
For those people who rely on regular income, that consistency of that paycheck coming through, inflation really is a difficult thing to handle, both mentally and from a financial perspective. For those of us who do the regular grocery shopping, you walk in and find that, gosh, this costs a heck of a lot more than it even did last week. Those little incremental increases in the cost of goods that you were used to buying for, in some cases, much less, all lend themselves to putting fuel on the fire of the biggest fear retirees have, and that is the potential of running out of income during their retirement lifespan. So it has both a physical sense of, gosh, it costs more. Also, it's a mental weight for a lot of people in retirement in terms of that big fear that they have of running out of money.
Okay, so if headline inflation is cooling closer towards the Bank of Canada's sort of 2% range of comfort, that seems to help in some respect. I'm kind of looking for a silver lining to this, as I'm sure you can imagine, because we're seeing that pressure on purchasing power, but that pressure is somewhat easing. But what's interesting to me is that you talk a lot about when you retire, you're so focused on saving, but you really should be, to your point, focused on spending.
The numbers as it relates to retirement this year, from what I understand, on CPI, we're running around somewhere between 2.5 and 3%. And we were in a 1.6% inflation rate, literally from the end of the financial crisis up to and including the end of 2020. And then all heck broke loose in 2021. And basically between 2021 and 2024, not even counting what has happened this calendar year today, prices rose, according to the CPI, roughly 16.5%. Add this year, and we're probably closer to 20. The problem with inflation, there's two things that are critically important about understanding the impact of inflation, is that once inflation's happened, it can go back to the rate that it was back in 2020, let's say, but the damage has been done. You've got this 20% increase in between. It's not like things go back to where they were 5 years ago, like the stock market recovery, getting back to a certain point in time. It is there, it's baked in, and we have to live with that. And any future adjustments will take those years of higher inflation, obviously, into account. The second big issue is that inflation really is an after-tax number. So if you are trying to cope with, let's say, for the purpose of using this illustration, using round numbers, if you were dealing with a 3% inflation rate and your income source is fully taxable, you may have to have a 5% rate of return to get a 3% after-tax cash flow to deal with that inflationary change. And those are challenges at a moment in time where you're looking at using your assets, preserving your assets, and on that fixed income paycheck that most retirees are.
2008 financial crisis, my parents retired, and oh my goodness, the stress associated with that. Let's talk about the sequence of returns and how dangerous it is when inflation is in the picture.
Sequence of returns it really has a huge impact on that 5 year window, either before people actually start their retirement or the 5 year period after. So that's that. They call it the 10-year window of caution or danger, depending on how dramatic you wish to be. But in the case of people who are retired, let's focus in on that group. Those are the people that have made the decision to stop working. They no longer have employment income, although there are some interesting numbers about how many people between 65 and 74 have gone back to work. And the sequence of returns basically suggests that if you're withdrawing at the same time markets become negative in terms of how the returns fall out, that can be putting you in a really dangerous spot in terms of capital preservation, which of course is income sustainability, due to the fact that you have a double drawdown effect. One of the themes that Dynamic as a company has been working on is the mantra of spend income, not capital. If we're able to have investment solutions aligned with the financial retirement income plan and have the focus on let's spend the income that's being generated by these investments, it basically gives you the opportunity. I'll be careful how I phrase this, but it greatly lessens the impact of a negative sequence of returns for the investor because you're not selling anything along the way. That's the whole idea of the paycheck portfolio strategy. We're not selling units, we're not selling investments. We're simply spending the income that's being delivered by the portfolio. That takes a huge negative, potentially negative aspect through the sequence of returns off the table.
One thing we haven't talked about when it comes to inflation is the idea that the Bank of Canada has a basket of goods it uses to determine what the cost of living is. But that's just broadly speaking for the general population. As soon as you hit a certain age, the things you're spending money on change. And I'm thinking healthcare primarily, but also property taxes. Travel is another example. Now that you've got all the free time, you're going to want to spend it.
It's our job as advisors, in my opinion, to help those people in their retirement years merge their time with their money. They work in tandem, they work together. And you're right. There's a period of time after people retire where they do start to realize the things that they wanted to do. Let's call it the immediate bucket list for a lack of better expression. And from our experience in working with retirees for over 35 years, we would see that phenomena happen. There's more spending at the time that they initially retire. It tends to plateau as they get into their mid 70s and actually decline as it relates to discretionary spending. You're correct. The property taxes, the utility bills, all of those things, those don't abate just because you may not be using them to the same degree. But travel will back off, and then the curve swings back up as people get into their late 70s, into their 80s. The curve of expenditure swings back up, really primarily due to the cost of healthcare. And that's all sorts of different things. It could be remodeling a home, it could be specific care someone needs. That's how they trend up. So it's almost like a little smile pattern of spend, abate, and then spend again, but on very different things. You're 100% correct.
The cost of living still climbs over time, particularly in areas that matter most to someone over the age of 65. Daryl reminds us that retirement isn't about hitting a number. It's about generating reliable rising income. A well-built plan accounts for personal inflation and separates near-term spending from long-term growth. But I wanted to look beyond today's headlines. What is the Bank of Canada signaling about inflation in the years ahead, and how should retirement plans adapt when interest rates move? Based upon everything we've talked about, where do you see the Bank of Canada predicting inflation going from here? Because what they think affects interest rates, and that ultimately affects us as investors.
That's a question with who will win the World Series next year. Those types of projections. The whole idea of trying to predict anything in retirement, whether it's somebody's health, the rate of inflation, what's happening with interest rates, what are the markets going to do? All of those factors, plus many more, contribute to a statement I like to use about advisors' role for clients at this time in the client's life when they're retired. You have to help them navigate these things because there's just so many unknowns that come into play. More so, by the way, and change is more dramatic than people will have experienced through their accumulation years in the vast majority of cases. So the answer to the question, I think that, as I mentioned previously, once inflation happens, you can't just, as the saying goes, put the toothpaste back in the tube. So central banks, especially cognizant of those people with limited and or fixed incomes being the individuals that they want to protect the most in the society, are going to do what they can to suppress inflation. We saw evidence of that through the 2022-23 period when interest rates were raised at a record pace, a record number of changes, all with the intent by central banks across the world, but particularly North America, to try to suppress the rate at which inflation was increasing. So I wish I had the crystal ball to tell you where it was going to happen. What I can tell you with a reasonable degree of comfort and certainty is irrespective of the actual number, the actual rate, it's going to be here in one way, shape, form, or another.
I ask the loaded question knowing full well that you've got some very particular opinions about dealing with inflation. But I ask because, if the Bank of Canada keeps cutting the overnight lending rate, it means guaranteed yields are less generous over time. And so this sort of brings in the idea that you want a layered income approach based upon sources that come from more than one aspect of your portfolio. So what do we do as far as that is concerned? Because you've warned against in the past building plans based upon where you think interest rates are going and where inflation is going, which sort of negates our entire conversation.
Well, for people that are involved with the Canadian Association of Financial Planners, and I hope and trust most viewers on the advisory side are affiliated with these types of organizations. When you're doing your planning work, they're giving you, if you will, their view of the thresholds of what returns should be, what your presumed inflation rate should be. Keeping in mind one big factor, when we're doing sessions like this, talking about retirees in general, you're dealing with really three distinct groups of people. So it's so difficult to just say everyone should do this, this, or this. It's all tailored to the specifics of the situation. If we can just confine our discussions to those people that advisors would be most inclined to be working with, and I'm not going to throw out a threshold of investable assets, but the issues around someone who's living strictly off income from their portfolio, individual stocks and bonds, and just spending dividends and interest, their issues are extremely different from someone who's totally dependent upon government sources to fund their retirement. So there are a few things in play that to some degree help abate the impact of inflation. And I'm not saying completely eliminate it, but you have indexation of certain government sources such as CPP and OAS. And depending on the retiree situation, that may form a reasonable percentage of their overall income. So if that's inflation adjusted, that helps. If interest rates come down, that that's a negative because a lot of retirees are far more conservative. And of course, bonds, REITs, and GICs in particular may be affected, irrespective of some initial capital appreciation for bonds and REITs. If interest rates continue to come down, the risk-free rate of income for retirees who like to lean on those more conservative investments, such as GICs or cash, that creates a real problem. But the government's main role in this whole big picture is to help keep inflation suppressed. It seems that you go the exact opposite way if you're cutting rates, and yet cutting rates for either savers or people with mortgages. On the other hand, they've got the flags out there cheering for that kind of move. But retirees, it's a totally different picture as it relates to a cutting of rates and conservative portfolios. It's kind of a double whammy if inflation is still nudging up at the same time.
So the Bank of Canada expects inflation to settle around its target, although global trade and supply pressures could certainly complicate that path. As policy rates eventually drift lower, retirees may find guaranteed yields less generous. Layered income with both secure and market-linked components becomes essential. It feels like Daryl is emphasizing discipline over prediction. But how do we turn these principles into a retirement income structure that pays the bills today and delivers raises tomorrow? So, knowing that we don't make investment decisions based upon the state of inflation or the direction of interest rates today, give us a high level sort of architecture, build that sort of foundation for us for a retirement income that can handle inflation.
We always talk about building a foundation, and our preference was to use the less tax efficient, less flexible, I'll explain that in a second, sources of income, just to create a layer, just to create a fully taxable base up to maybe a certain threshold, be it the first or second federal bracket, to use an example. And of course, there's intervening provincial brackets in pretty much every province and territory. But once we get up to a certain level of taxable income that generates the after tax cash flow we're trying to create for the client, one of the other aspects becomes, are we able to, with the resources someone has, take some of the investment capital in their situation and dedicate it to maybe a ribbon of growth in a portfolio, so that they have the opportunity to grow some of the capital, cascade it down eventually when it's needed, if it's needed, into more income producing assets, and help deal with inflation that way. Uh, and the answer is yes, that is an option, and it's a commonly used option. And it's not that we think it's a bad option. It's just that there are two considerations in that course of action. First of all, it's great when everything grows, but of course, there's years we see where things are flat or even negative, and that's capital we were dedicating to put us in a position to increase our income down the road. So there's that factor to consider. The other is, do retirees want to take on the additional level of risk for a specific segment of their capital with the hope that it has the potential to grow? So the solution as we see it, coming back to spend income, not capital, if we can take some of the income producing investments that we have and reinvest those distributions instead of paying them all out, what we're doing is we're buying more units or individual stocks, depending on how your portfolio is set up, by reinvesting some of that income. That does two things. Obviously, it gives us the opportunity with much less risk to increase our income down the road at a point in time of our choosing. The second thing it does is it negates that sequence of return risk that we talked about previously. For people that are reinvesting consistent distributions, as silly as this is going to sound, they want the markets to be volatile and even to go down, because dollar cost averaging works in their favor in terms of building that block dedicated to future income. So people will look at that and go, yeah, but I'm a retiree. You're asking me to save in retirement. I thought my saving days were all done. Maybe not.
I particularly love the DRIP idea, your dividend reinvestment program idea, but you also recommend carving out what at least a year's worth of essential withdrawals in cash and short-term instruments back to your point, so that you don't end up selling that base capital necessary to bring you the income you need.
We call that the cash wedge. And we use that very, very significantly from about 1988, first retirement income plan I ever wrote, to just after the financial crisis, and combine another strategy, which we've already discussed in the paycheck portfolio strategy. But the cash wedge was just that, Michael, in the sense that it allowed us to access a buffer of cash if there were periods of time, and of course there always are, where markets decline. And depending on what the other income producing assets were with that client or clients in their situation, we might have 1 year, we might have a year and a half, we might have 2.5 years worth of cash, just so, if you will, we had a safe harbor to go to should markets precipitously fall. One could look at it and say, well, yeah, but you're still selling assets in a down market. No, you're using assets that have been previously turned to cash from profitable positions to fund your income, while the rest of your portfolio basically gets a chance to heal over time. And from our experience, they always did. We just didn't know how long it was going to take for them to get back to the dollar value they had previously been at.
Help me understand, though, about how you engineer the raises that you're going to need as inflation comes up. Like, my grocery bills are on the rise as a retiree. Should I just be pulling more money out, or should I be setting like a specific date to review my financial portfolio and how much money I'm withdrawing?
Of all the times for people to be working with a financial advisor, this pre-retirement phase and throughout retirement is probably the most critical point in time to be using counsel from someone who's been to the movie, so to speak. For retirees, they retire once, maybe twice if they've gone back to work or doing some consulting, but really that's not what you'd call a great level of experience. For advisors who do focus on this area of retirement income planning, they've been to this movie a number of times and know of different opportunities, strategies, ways to help retirees cope and deal with the inflationary pressures. I found the decades that we worked with retirees, they're a very resilient group in terms of being able to adapt to the circumstances that present themselves at any given point in time. I use the word navigate, and I use that word with great affection because we found that people were tremendously flexible. And maybe in a year of very poor returns, if we're using a cash wedge, even if we're using a cash wedge scenario, or even if we're using the paycheck portfolio scenario, maybe they put that trip on the river cruise off for another year. The complication comes down to when it's the necessities, when it's your gas bill, when it's your heating bill, where it's your grocery bill. Those we have a little bit less discretion with, but still some malleability, flexibility. You've seen cartoons of retirees reading the flyers from the grocery stores as a source of entertainment. That's not too far off in certain cases, but by and large, I'm happy to tell you that through the actions of both what we did in an advisory capacity and the recognition and the actions on behalf of the client, we never had anybody run out of money. I think it's a valid fear because you see so much about it in the media, but there are steps that can be taken both from an investment perspective and also from the actions of the retirees themselves to help diminish the impact on their overall financial well-being when we're going through periods of inflation as we were from 2021 to 2024.
I think there's a particular eureka moment in our conversation today that nobody else is talking about, but what do you think it is?
Plan to have some capital or some income dedicated for mailing down the road in whatever way you choose to do that. Growth investments, reinvestment of distributions. That to me is not only an effective way to deal with inflation in the future, but it also helps you as a retiree be more comfortable with what you're spending now.
You're not just spending in retirement, you're saving in retirement too.
Correct.
Thank you so much for your time and insight, Daryl.
Thanks, Michael.
We've discovered that retirement income planning begins by acknowledging the inflation reality. Retirement is not a single event, it's a long-term financial project. When we build a plan that respects inflation, understands market risk, and delivers a structured path for rising cash flow, our nest egg is no longer just a number. It becomes a strategy that's on the money. I'm Michael Hainsworth. Thank you for joining us.